Alrighty, I am in. Can you guys hear me?
I can hear you.
Awesome. Dan, I can hear you now too. Good.
Okay. Yeah, I had to start. We live stream this to YouTube. Nobody
Okay.
ever watches it, but that's how we record the session. And
Okay.
then it'll be do you want to turn on your video?
Yeah, I thought I had it on. Is it not showing?
I'm not seeing anything.
Hold on
Nice.
one second. It's interesting because it was working previously. So hold on one moment. I'm gonna call some technical support. Hey, so I'm logged in right now, and as a panelist, they cannot see my screen. Like they can't see me. The webcam might not be working. Okay, sorry. Thank you. Bye bye. Sorry, we're working on it. Just hoping that we could get it.
Okay.
It
Well,
was
as long
working
as we
when
can
we,
hear your voice, that's fine.
okay, well, yeah, first comes to worst, but I think you probably want to face to a name. And I
Yeah.
appreciate all the last minute changes. I'm sorry about that. Just
Yeah.
things came up.
I understand that you're busy. I'm not, this was a good morning for me to be able to quickly respond to you.
Yeah,
But lesson learned for the future. If possible, try and, grab this stuff when you can.
of course, of course.
Yeah. All right. Down at the bottom of your screen, you should have two little icons over on the left, a little picture of a microphone and a picture of a video icon. What is the video icon showing?
It does say that it is showing video. It's telling me to stop video actually. So that's
Okay, tell you what, right click on the video. There's a little carrot there. Do you see the little carrot next to?
yeah.
All right, go up and select. Tell me what video devices are on. It's telling you to look at. Tell me what video it says. So it should come up with a little menu that says select camera.
Um,
Right
it
click on it.
it is on the camera that we have plugged in.
Okay,
So no. Will I just have to use the one from?
Well, I'm gonna try switching to it,
Oh,
there you go. Okay, there you're in.
but
I can
that's
see
not
you.
the one we want
This
to
one.
use. Yeah,
Yeah.
let's try switching back now.
Trying one more thing. I like that frozen screen idea.
I'm not a fan of how I look on it. Yeah, I guess you're gonna, I don't know why it's not accepting. We literally tested this 10 minutes ago.
I know, yeah, we literally just tested this. That's what makes it
Yeah,
interesting.
that's what makes
But
it
that's
very
fine.
unusual.
We can use the other one.
Yeah, I guess you're gonna have.
Yeah.
I don't know.
That's fine. I'll just stay over here.
All right, so we'll just
I just move this over here. So I'll stare at it.
yeah, I don't know why.
Yeah.
See both of you perfectly now.
Oh, great. Well, hey.
Okay, okay. Elizabeth, welcome.
Thank
Uh,
you so
all
much.
right, you'll introduce yourself and your background and your organization affiliation. And you're welcome to, some people like to do this, others don't. It's your choice. If you want people to contact you as a follow-up, you can give out your contact information or general information for your business or organization.
Okay, this sounds good.
Excellent.
You have your presentation pulled up too.
He's actually
He's running it.
Yep.
Okay.
Sorry.
Okay, sure. Basically, I will share my screen. All you have to do is say next slide. And
Perfect. I love it.
And
That makes it easier.
on the Q&A, they may come in via the chat or the Q&A. I can see both of them.
Okay.
If you like, I can read the best questions. Some of the questions are not so germane sometimes, or they're very personal about their business and we can't answer them.
Sure.
But I'll try and get the ones that are most appropriate for you. We will finish up right at the top of the hour. The reason for this is we do this at lunchtime. because a lot of people have day jobs. And so we
Yep.
found that noon is just a fabulous time for them because they get a sandwich and sit down at the computer and, oh, I'm having my lunch, and they're actually watching a webinar, so.
Yeah, no, absolutely.
So how'd you get into the banking industry?
Yeah, actually, I started when I was 21. So it was 13 years ago. And
Congratulations.
thank you. I appreciate that. Yeah, I've literally spent my whole life in the credit union space, which has been awesome. It's actually been with Comstar Credit Union. So I got into lending in 2015 and then business lending in 2017. And so I've just kind of been getting promoted from within as we go
Right.
along.
Congratulations.
Stuff. Thank you.
That's great.
This is my first presentation doing scores, so I'm gonna do my best.
Well, how many presentations have you done to management? I mean, just put on
That's fair. Enough,
Okay,
enough.
all right,
But
so,
this one I've never done, so we'll
okay,
see.
did you ever see the movie The King's Speech?
I have not.
Okay, it's a story about a man who's a speech therapist who helps the King of England in 1940 get over a stutter problem. And they finally have to get to the climax of it. He's had to give a speech to the entire British Empire. And so the speech therapist says to the King of England, just talk to me as you would a friend.
Yeah.
And so I always tell people, just talk to the microphone as though you were having coffee with a friend.
I like that. I like that a lot.
And that movie's out there. It's a great flick.
Yeah.
If you have, if you like period pieces, but
Yeah, no, absolutely. It sounds familiar. Yeah, I don't disagree. I think that's actually a good
pretty
opportunity.
cool. I'm going to start the regular session now.
Okay.
And I'm going to bring up my slides and share my.
Perfect.
All right.
And when we go to the slide part, is it okay if I stop my video? But then
You can start. You can stop your video at that point.
Okay.
That'd be
Just because
fine.
I have some notes.
Okay, so I'm going to introduce you as Elizabeth Patrick, Vice President of Lending with Comstar. Is that correct?
That's perfect. You can call me Liz as well. I go by both.
Liz, very good. Okay, we're on our way here.
Excellent. Thank you.
Good afternoon, everybody. My name is Dan Yerman. I'm a SCORE mentor, and I'm here with Liz Patrick. She is the Vice President for Lending at Comstar Credit Union, and she'll be doing our presentation today for the life of your business. Actually, no, I'm making your plan bankable, beg your pardon. And we will start in just a minute. It's just top of the hour. We want to give people 1 more minute if you're grabbing a sandwich or a soft drink, so you can settle down and watch at your desk or wherever you might be. So we'll give it 1 more minute for people to join, and then we will stop again at the top of the hour at 1 o'clock. We're going to have time for Q&A, Liz will be delivering all of the slides, and I'll be in the background. I'll be keeping an eye on the chat and the Q&A, and when we get to that section, I'll read them off, and then Liz will work her magic to give you answers to your questions. This is SCORE Cleveland, and the webinar you are in is called Making Your Plan Bankable. The presenter is Liz Patrick, Vice President of Lending at Comstar Credit Union. Liz, you're on.
Hello, everyone. My name is Liz Patrick, and I'm from Comstar Credit Union. Like Dan said, I am VP of Lending currently, and I actually started my career as a credit union. I actually started as a member service representative on the front line back in 2011. And then in 2015, I moved up into the loan department. And most recently in 2017, I started doing business lending. So I do have a credit union business lending professional designation. And I've worked as a credit analyst, an underwriter. I've even worked as a business loan officer as well. So I've done a little bit of everything on the behind the loan department area. And I'm really excited this afternoon, to give you an inside look on how lenders review your application from start to finish. And it looks like a couple of these first slides are a little bit about SCORE mentoring, and what they offer as well. So, yeah, a little bit about SCORE, here's that information, and we can continue on.
This is the SCORE website. And if you want to get a SCORE mentor, just go to the SCORE website and click on request a local mentor. It's a little blue box in the lower left, and it'll take you to a dialog box, which will help you get a SCORE mentor.
Perfect. Okay, so I just wanted to start my presentation behind the lending curtain. So it's literally an overview of what lenders are considering when you submit your business loan application package and why you won't have an answer tomorrow. You can go to the next slide. So first I want to say, we can actually go back to the previous slide.
Hang on a second.
You're fine.
My navigation's not working very well. I can go forward, I can't go back. Well, hang on a second here, just a minute. Let's go back here. There we go.
Perfect. Thank you so much. So again, congratulations on taking those steps to own your business. Today, we're going to discuss briefly about how a financial institution will review your loan request. And we'll also focus on some of these areas, including the matrix, risk buckets, the committee vote, yes for now, no for now, structures, and commitments. Next slide. So a little bit in the beginning, the main focus you want to start on is the banking relationship, whether it be with a bank or another financial institution, such as a credit union. We're looking for whether or not your business is a sole proprietorship, an LLC, an S Corp, a partnership, a C Corp. It's just good to be registered with the state, and if possible, acquire an EIN with the IRS. At Min, though, you do want to create a trade name with the state of Ohio. So there are multiple business structures that will need different type of paperwork as well, such as an operating agreement or articles of incorporation. And it's important to, with each financial institution, everyone's a little bit different, but some have the same consistent standards with the banking relationship. The main thing is establishing that relationship. Relationships matter. It's important to know who your go-to banker is and your loan officer as well. They support you and your requests. So having or being passionate about your business is important for the success of your business and your potential loan application. An example that I have is actually someone I spoke with kind of recently, and he was a chemist. He was a chemist by trade, and he was looking to open a brewery. And I could just tell because he did so much research, and he was so passionate about how to create the beer and how he brewed it and everything like that. And it was just really interesting. And because of that, I really knew that he put in the research. Another thing to consider is SCORE help. Obviously SCORE is a very great resource, and I know many of you can attest to that are on this webinar. And they're definitely, they have mentoring services, which are free and can be beneficial to you. As a loan officer, I can tell which businesses have worked with SCORE. Not just because they tell me, but you can tell that they're very prepared, and they even have, a business plan, which is very important, particularly with startup companies. The reason why a business plan is important, it just provides a detailed narrative of your business and its goals and management. A business plan, if it is more for a startup company, if you're starting up, we do require, 2 to 3 years of financial projections as well. Another important thing, and you'll see this in the next couple of slides, the loan application package is really important when submitting your loan request, and there's a lot of documents that you're going to need. And if we go SBA, which is another option, there is even more documents needed. It's also important that if you have more than one owner for your business, owners essentially exist at 20%. So anyone that owns 20% or more of the business is considered a principal, and they will be required to personally guarantee the loan. Some other items to mention, with a business loan, you can be personally responsible and reportable, because we do take into consideration when we review your loan request, your personal credit report, any additional income outside of the business, whether it be a different business that you have or W-2 income. Break even for your business is actually like 1-to-1. It's actually 25 cents short. And I can go in a little bit more into detail about transactional versus global debt service coverage ratio here shortly. It's important to note that you ought to love paying your taxes. I know as a business owner, you want to write off as much as you can and everything like that just to pay the least amount of taxes, but that can decrease your chance for getting a loan. And I say that because, again, with your accountant should know what debt service coverage ratio means, which is DSCR. But what that is for transactional, what most financial institutions are looking for is 1.25 to 1 ratio. So what that means is for every dollar that's going out, you want to bring in $1.25 in profit. An example of transactional is just the business itself, the entity itself. In the simplest terms, I would say if it was an investment property with a single tenant, you would take in the rental income. So that'd be the income. And then the expenses. So the expenses would be taxes, insurance, stuff like that. If there's a mortgage against it, those kind of payments. And you want to see, again, 1.25 coming in versus $1 coming out. For global, that would include any businesses that you do own, personal guarantors, and the business itself. So we do take into consideration as that as well. And 1.25 to 1 is our main focus. It's also important to understand that lenders are not investors. And the reason why we say that is that you wouldn't want to pay more if your business is going to do well and is performing. You just want to pay what is agreed. And another item to mention is that transparency builds trust. And I fully agree with that, with the documents that we request and the conversations that we have with the borrower. I think it's important to just be upfront and provide as much information as possible regarding your current situation. I personally, when I speak to a borrower or a potential borrower, I let them know upfront, hey, this is our structure and how we look at loans, and this is what we're interested in, and kind of gauge based off of what they're interested in, how we can help them the best. Next slide. So on the next slide, I know I discussed a little bit earlier, the requested documents. So these are some of the documents that you're going to need. And actually, this is more for higher dollar loans, which is more like above $50,000 and above. Anything below $50,000, there's going to be a little bit less that's going to be requested of you, and I can discuss that. But basically, for anything above $50,000, this is what we're looking for. So we're looking for a fully completed and signed loan application, a personal financial statement, which a personal financial statement is essentially a balance sheet as well as an income statement of your personal finances. So if you own your own property, it would be considered an asset. So if your property is worth, 100,000, that would be included in your assets. On the liability side, then it would be the mortgage against that. And it would only be based off, again, your personal finances, nothing to do with your business. And the income statement as well, so it would show your income from you personally, and then any expenses that are taken out. We'll, consider a current business P&L statement, which is a profit and loss statement, similar to an income statement. We'd also maybe consider, reviewing 3 years of previous as well. 3 years of business tax returns, 3 years of personal tax returns. With the 3 years of business tax returns, I understand that some businesses, if you're new, you obviously won't have that. So we do take that into consideration. And that's where your business plan with the projected financials come in as well. You could need to sign purchase agreements depending on what type of loan this is for. Rent rolls if needed, collateral descriptions, signed lease agreements, leasehold improvement, construction contracts, proof of insurance, accounting firm contact information in the event that we need to reach out to your accountant for additional information. The IRS 4506C, if you're a nonprofit, the 990 filing instead of, the tax statements, because you don't file those. Proof of equity. So if you have any sort of down payment or you've put any money into the business already, an example I could give is we were doing a construction loan for a member to build their commercial real estate on a property, and their proof of equity was the purchase of the land. So it did show that they purchased that, and that was a portion of their down payment. They may need to provide, tax returns of other owned entities, state of Ohio filings, IRS, EIN, TIN filing, 3 to 12 months of bank statements, and that could be for both the business and personal. Environmental questionnaires, debt schedules, which the debt schedules would be for your business and other businesses that you do own if you own 20% or more of that business. And then also if need to, proof of current taxes is also necessary. So these will be the documents that we would request for your loan request. Again, these can change. There might be a little bit less. There might be different documents we might ask for depending on your current situation and your loan request. But this is pretty much the general standard. Now, if you go to SBA, and we're considering an SBA loan, on the next slide, we'll see additional documents that we'll need. So there's different SBA applications. You can show your business valuation. I'm not going to go through all these because there's a lot. There's the 1919, which is a borrower information form, the 610, which is anything that involves $10,000 or more in construction costs on leasehold properties or even building, whether it be a building or some sort of structure. The 413 is again another personal financial statement, but it's from SBA. If you're looking to open a franchise, you do have to go through the franchise registry process. If you're refinancing, there is an option to do so. We just need, copies of all your notes just to confirm that we can, proceed with it. There is a good chance there would be a lien filing against your primary residence. Proof of equity again. And my favorite quotes, other supporting documents not identified elsewhere. That's not just for SBA requests, that's for conventional requests as well. We'll also do what's called a lender credit memo, which is essentially our narrative of your loan request. And it provides the spreads of your business, gives history of your business and what you're looking for in the future as well. With the next slide, once we submit your loan application, and you can do that either by scheduling a time in person with your loan officer, or in Zoom to go over the loan application package, or even, if you have a working spot already at your business, we can, stop there as well. We can meet at your business to see operations. So after submitting that application, there's kind of what we call like a stool. There's 3 legs of the stool that go through and review your loan application, which also with, reviewing all those documents that we received, that's another reason why we don't have an answer tomorrow. So what the lender is doing with his information, initially the loan officer, and again, each lender has a differing process, but has very similar consistent standards. So the loan officer, generally, what they do is they're going for battle for you and is your main point of contact. They're the one telling your narrative and the reason why we should proceed with the loan request. So the loan presentation gets presented to the business loan committee, which is the second part of the stool. But the loan presentation, just to give a little bit deeper into it, it provides the 5 C's of credit, which is the cash flow. The first one being the cash flow, which we discussed briefly, the transactional versus global. Character, how you present yourself, states a lot about how you conduct your business, and it's important to have good character on that end for your business loan request. Capital is important. It's the evaluation of a borrower's risk of failure, understanding the business's net worth, making sure they're not over leveraged, and understanding that you have enough cash flow to proceed with that. The fourth one would be collateral. And collateral is very important as well. But it's also important to understand it's not the first C of credit. So it's not as important as cash flow. You could be at a spot where the loan to value based off of what you're requesting and the appraised value of the property is very low. But if there's no supporting documentation that the borrower could pay it back, that could be grounds for a denial. And the fifth one being conditions. So we do what's called a SWOT analysis, determining the strengths, weaknesses, opportunities, and threats for the type of business that we're reviewing. And so the loan officer, what they do is explain to the committee the request, your history, your management qualifiers, and how this request, your loan request, would benefit for your business. It also defends their risk matrix score, which we'll go into deeper on our next slide. And also, again, the loan officers in your court, they're going to advocate for borrower approval. So it's really good to have a strong, transparent relationship with your loan officer, understanding, they may ask some questions that you might be like, well, I already answered it, or don't feel comfortable answering. It's going to help determine and whether or not to proceed with the loan request. So the second leg of the stool is the business loan committee. So what they do is, again, they review the loan officer package and the loan presentation that the loan officer provides. What they also do is they evaluate the risk profiles. And by doing so, they determine exactly, we review, essentially, each business has what's called a NAICS code. And based off of their market, it determines whether or not it might not be the best time to go into a specific business. I guess my example would be like when 2020 happened, COVID, there was hotels were kind of shut down for a little while. So at the time, that might not have been the best item to proceed with unless they were able to show that they were, still operating and having the cash flow that they needed. The business loan committee also evaluates what's called the financial institution's concentration position. So each financial institution has a specific bucket for different types of businesses. So if your business is a retail, then what the credit union has is a specific bucket for that. So I think ours is like 25% for retail, but it can vary. And if there's too much in that bucket, then we may not be able to proceed with that loan request. Or we can consider what's called a participation loan, where we participate out an additional amount with another credit union or financial institution. The Business Loan Committee also reviews whether or not it's going to be a conventional or SBA loan. So a conventional loan is just an in-house loan. And the SBA loan is if it might need a little bit extra, it needs a little bit more risk mitigation. So SBA is good for startup businesses. It's also good for businesses that are growing that might have a little bit of a shortfall of collateral, or maybe a little bit of shortfall on debt service coverage ratio and items like that. While the Business Loan Committee is reviewing, the loan officer also discusses mutually beneficial structures for the loan. So a lot of what you'll see is a term and an amortization. So it's going to be like a balloon loan. And so say, you know, you request to borrow $100,000 and the term it would be 5 years, but amortization at 15 years. So for the term of 5 years, after 5 years, what happens is that it goes into a renewal process where we review market rates and review the collateral, make sure everything is good. And we can change the term again. We could also re-amortize it out. And that we'll get that more in the next session, but I just wanted to share that with you a little bit more. The amortization, so with a 5-year term with a 15-year amortization, essentially what that does is you're making a payment on a 15-year amortization instead of a 5-year term. So that helps your borrower cash flow. It reduces the amount that you have to pay. And at the end of the 5 years, again, we'll go into that renewal process. The loan officer also shows conditions to offer as well. And a condition could be like a UCC filing, a blanket UCC filing on all your business assets or even other businesses that you own as well. It also defends, like I said, the risk matrix score and advocates for borrower approval. And it also provides the Business Loan Committee, once they review it, they might provide additional conditions needed to offer back to the borrower. So, you know, maybe there's a condition to offer on the loan officer side, but after the business committee reviews it, they're like, well, you know, maybe I agree with the UCC filing, but also let's make sure all the tenants sign a non-disclosure agreement to confirm that everyone is covered and protected. And we can go to the next slide to review the third leg of the stool. So the third leg of the stool, which we'll discuss more in part 2, is actually the underwriting piece. And I like to show this picture of underwriting essentially as the Grim Reaper, because they're what's known as sometimes on occasion, the dream killer. I agree with it to an extent, but I mean, there are times where as an underwriter, you know, we want to protect not only the business, but we also want to protect the financial institution as well. And when we go to the next slide to review, I know we discussed briefly the matrix. So to go with this slide, each financial institution has its own way to evaluate and assign risk scores. So again, they could change, but here's some consistent standards, which is in the risk scoring model. The first one, the score matrix, generally the scoring is between 1 and 10. Ours is 1 to 10, and I have seen in some occasions it's 1 to 8, but it can vary. And most financial institutions want to see a score between 3 and 6. It's important to understand that just like golf, though, the lower the score, the better your scorecard, which equals lower cost of borrowing and higher likelihood of approval. So there are many how do we fall into these scoring factors. So debt service availability, which I discussed, we take into consideration global and transactional. Credit scores is very important of all guarantors that sign. LTV as well is one of those factors. The lower the LTV, the lower the scoring, which would help with your likelihood of approval. Other financial ratios, one that we look at in particular is the debt to net worth ratio to confirm that you're not over leveraged, as well as liquidity, just confirming that you do have enough cash to cover what you're looking to purchase. We do take into consideration the type of collateral. If it's commercial real estate, is it equipment? Is it a vehicle? Is it cash? Those types of options as well. And we do also take into consideration years in business and management experience. And it's important to know that each item is weighted differently based on the type of the risk. So debt service ability is actually weighted more heavily than management experience or years in business, or LTV. So that's important as well. There are some mitigating factors that would help the score as well. So say you're, on the higher end around 6. If we notice in our reviewing the loan package that the available cash or liquid assets is a good percentage of the loan balance. We do consider market conditions as well, your cash flow trends, and if there's an SBA guarantee. And then also we do consider the risk buckets, which we'll discuss a little bit more on the next slide. So reviewing this is our risk mitigation barrel. So on the first side where it says barrel flow of risk, you can see that everything's a little tight. So the loan dollars are high, the equity to LTV is pretty low comparative to the amount of the loan dollars. So that could be, we're at 80% LTV, and debt service coverage is pretty light as well. And by seeing that debt service coverage being that close to the equity and LTV, that could be, we're looking for 1.25. This is probably looking at like either 1-to-1 or maybe 1.15. So this one is essentially a barrel full of risk when you review that. Now, if you look at the barrel empty, it's a little bit different, a little bit more spread out. So a barrel empty, we're seeing, a higher debt service coverage ratio, and that could be both global and transactional or one or the other. And that could be above the 1.25. So you're looking at 1.5. Equity is a little bit, equity and LTV, the LTV is a little bit lower. We're at like 60%. So, the down payment's 40%. And then also loan dollars are a little bit lower as well. In order to sort of mitigate the risk that you see on the left-hand side, they could consider what's called an SBA guarantee. And Dan, if you could click on that slide too real quick. So SBA guarantee is what they do is help mitigate that risk. And SBA guarantee is just a government backing on your loan to help in the event of a collateral shortfall or a debt service coverage ratio shortfall, or even an equity shortfall. It just helps get borrowers to a loan and get to yes on this process as well. And on the next slide, we'll review the decision of the committee. So once we review all those items, understanding which way to go, if we're going to go SBA or conventional, or the options that are necessary, they go for what's called the committee vote. So if we're going to say yes for now, let's review, the conditions of the loan. So the conditions, I think I discussed them a little bit briefly, but they could be as simple as, UCC filing on all assets, It can also be just ensuring that you do have insurance on the property or the collateral that you're securing the loan with. It could be, again, something like a non-disclosure agreement between the tenant and the borrower itself. And just the items needed in order for the loan to close, and they help with that transaction piece. Covenants are a little bit different. They're actually stated on the loan documents that the borrower must agree to, and they promise to commit to these and they actually do get reviewed during the life of the loan. So a covenant could be that the business entity must maintain a 1.25 debt service coverage ratio during the entire term of the loan. It could also be that they would provide financial statements annually to review and make sure they're following those covenants. In addition to, if they aren't following the covenants, that could lead to a default in the loan, which could change the structure of the loan and could also deter any sort of renewal in the future. In addition to a yes, the committee reviews cost involved. So the cost involved, is there origination fee? If it's going SBA, what are the ongoing SBA fees? The appraisal costs, everything like that. Underwriting, if there's any sort of underwriting fee. And then also you want to look at getting the commitment letter, and it's important to get the commitment letter from your lender in writing and have the loan officer review it with you. Make sure that you understand that it's clear what the conditions are, the covenants are, and the terms of the loan. Also, once that commitment letter is signed, it goes through, if you need to, an appraisal process, formal underwriting, which again, we'll review in the next presentation. And they will have the final say in whether or not this is going to proceed or not as well. It'll also consider if we need any sort of participants. So again, I know we discussed briefly, if there's too much dollars in a specific market category, we may have to participate out the remainder amount. Also, if it hits a certain threshold of dollars, it could need a participation as well. And then again, for commercial property, it may need something more involved than an environmental questionnaire. They have what's called an environmental phase 1 and then an environmental phase 2, which they can become costly, but it does help determine whether or not there's any sort of environmental issues to the land. So, I mean, generally, if it's like an investment property, that's generally hasn't been used for commercial use. It's only been specifically for single family or multifamily homes. But there have been cases where a person wants to buy commercial real estate, and then it turns out from the owner, oh, well, there's actually a gas can or below the land, and it could affect any sort of environmental factors in the future, which could deter the loan as well. If the committee decides not to proceed with it for now, the reasons why it could be, risk score, you may not have fallen into the 3 to 6, maybe a little bit out. Concentration risk. So a lot of financial institutions have borrower maximums that a person can borrow. So if they exceed that amount, then we may not be able to proceed because based off of the concentration risk. I know we discussed earlier the dollars category, having too much in the specific bucket as well. The industry and NAICS category we discussed again, but that's where the participation could come in, where another financial institution could take part of that loan dollars. Another no for now is a lack of participants. So maybe, we send out your loan request to another financial institution and they don't necessarily have, they have concentration risk as well, and they're unable to do anything with it. Reputation risk is also a factor as a no for now. If, the the loan officer decides with doing the SWOT analysis, there's more risk involved than any sort of strength or opportunities there. If there's an appraisal shortage or collateral shortage, so, you know, you're saying you're buying the property for 200,000, but it only appraises at 180,000, that could be a no for now as well. Environmental issues, I know I discussed that a little bit briefly as well, and if it's not eligible for SBA. So SBA, they require that, you know, everything, the business is inclusive to everybody. However, you know, if right now, depending on if it doesn't follow federal law or doesn't follow specific federal guidelines, then it wouldn't be eligible for a loan. We can go on the next slide as well. So if it's yes or no for now, the next steps would just be to explain it to the borrower. So what the loan officer does is they go back to the borrower, let them know, hey, this is the reason why we're going to proceed, or hey, this is the reason why we decided to decline it. And at this point, what they do is understand, negotiate the terms. This is what the committee decided. And if they're, you know, this is the rate, this is the term, this is the amount, this is how, you know, this is what the conditions are. You know, we require that you make a deposit and escrow for a certain amount of time, something like that, that could change. And, you know, you don't have to 100% agree with it. We could, because we can always go back to the loan committee to see what their thoughts are. In addition to, you want to understand, negotiate the conditions and the covenants of the loan. And it's also important to, and I know I mentioned this earlier on, the commitment letter, get that in writing and signed as well. It's very important to get that because, again, this provides the conditions of the loan. It states exactly what the loan amount is going to be. It clearly defines the fees and the ongoing expectations of the loan during the time frame as well. And on the next slide, wow, so actually we're a little bit towards the end now. So for Thursday, we're looking at the dream killer, and we're going to go into underwriting, essentially, the approval process and funding, and then the funding afterlife. And what the funding afterlife is essentially what we're looking at for annual reviews and renewals in the future. So Dan, actually, that is all I have right now today.
Elizabeth, you want to put your video back on?
Absolutely. Hold on 1 second.
There you go. We can see you. All right. So this is the Q&A session. In your screen, you should see buttons for Q&A or chat. So please enter your questions there. I'll read them off to Liz, and she'll respond. So any questions?
And I do
By
want
the
to
way,
mention, oh, I'm sorry.
by the way, Sharon Rose will be your host on Thursday.
Great.
What was your question?
Oh, no, I just wanted to mention, in that last slide, it did have my contact information. If you do find that you have any questions, you can email me directly at Liz, L-I-Z, P as in Paul, at Comstar, COMMSTAR.org. You can also call me directly as well.
And we will be sending out the presentation slides and a link to the recording to everyone who attended today's session. And here's a question. Let's see. Karen, you're going to have to type your question into the Q&A. I can't open your mic for you in terms of the way we have things set up. So if you would type your question in, we'll read it off. See if she has a question. Who's going to type that or not?
Perfect.
Again, if you do have a question, please type it in to the Q&A, and we'll read it off. We have set this up so that panelists have their mics and video muted. Here we go. I want to buy a business. It will be around $1 million. I'm willing to put down 600K and want the other 400K in loans. The business does not have 3 years of business returns. If she's saying, what do I do now?
Sure. No, absolutely. I appreciate your question, Karen. And that makes sense. Do you know how long the business has been in operations? Because if it has been less than 3, okay, so it has been 20+ years. Okay, interesting. I guess it depends on the type of business. I would hope that they would be filing their tax returns, and maybe they don't keep more than 3 years of tax returns on file. I am not certain, but I would try to see if you're able to get a little bit more information from the borrower. I'm sorry, from the seller regarding that. I'm guessing they have been getting income from this business as well. They just didn't file the tax returns at the time.
Well, if the business, the question is this a cash business, or does the business have records? Is there an accountant? Can the business put you in touch with their accountant? Well, okay, are there other questions? Sorry, just jumping in there. I just
No, thank you, Dan. That helped out a lot. I appreciate it.
Yeah. Well, we get that a lot, by the way, that people have a cash business. So she wants to contact you.
Yeah, absolutely.
Hang on a second. Let me get something here. I'm going to put get my phone back here to mail. Mail here. Patrick. Okay. I'm going to put Liz's contact information into the chat.
Absolutely.
All right. So watch the chat here. I'm going to open the Q&A. Oops. Let's go back here. I want the chat. Here we go. Okay, I'm going to put in her contact information in the chat so you can all contact her.
And I'm just writing a few notes, Karen, about your question. So I appreciate that very much.
And I'm going to put your email address, which is probably best,
Yes.
LizP at COMM star.org. And I'll put your street address as well in case people want to know where to, if they set up an appointment, where to go.
Absolutely. Does anyone have any other questions they might want to ask in the interim?
Okay, so I'll put that information in the chat. Well, I'm not seeing any other questions, so we're going to wrap it up here at 12:45. Liz, thanks for a great presentation. There's a lot of stuff documents are us. And I guess the lesson learned is having an experienced lending officer to hold your hand through the process is the first success factor.
Absolutely.
Thank you, everybody.